10/1, 2012, October. Earnings season starts a week from today, Monday, and we're going to take a look at the S&P 500. This is a daily chart. What we did was we found this support level where this breakout daily bar was. However, that 50-day moving average is way down here, and the S&P has got the major support level right around this area. It'll be right above 1400, 1401, 14, let's just call it 1410 is that lower area here on the S&P. In order for the S&P over the next quarter, fourth quarter, to get to 1590 on the S&P is that you're going to have a great earnings season, and the bulls that underperformed all calendar year are going to have to step in and want to buy the dips. The problem that we have in the shorter term is that we know all the economic data points to lower growth. We also know that corporate earnings are at levels or peak levels within the stimuluses that have been injected into the system. We also know that the bulls are not participating. It's the only rally that I know that's had a 14% rally or so that's been the most hated rally on Wall Street. We've never seen that before. And what it means is that these markets keep climbing higher and higher for reasons that I'm stating here is that fundamentally things aren't great, but stocks continue to walk higher, and that's what they do. Now, when we get into the reporting session, they're going to have to deal with these lower earnings across the board. And that we did not have a correction in September because of QE3. If he would have came in and put it full to the metal, Mr. Bernanke, and did that QE3 injection, we wouldn't be at the highs that we're at right now. We would not. He came in, he saved the day for the month of September, but now we're in October. So I'm going to say that the S&P has to close above 1450 to make it to the 1490 area. Our year-end target, 1590 on the S&P, is that you're going to have an extreme rally in tech, and they're going to have to be buying the dips. And that what happened in the summertime is the reason why people hate this rally when they should be loving it is because they don't believe in it. They don't believe in the economic picture, and the ISM data was much better today. It's above 50. And we were way up here, 150. The NASDAQ went negative. This went negative. The S&P is kind of flat, and I'm not going to go into a lot of other analysis other than we are not as nearly overbought on the S&P as we once were a couple of weeks ago. But this is called a topping pattern. And until you get a close above 1450, you're going to have resistance in the very short term on the S&P. The 50-day moving average down here is where we would look for great support, where the last part of the highs of this rally happened over here, up here where the reversals were. And we tested support, and every support level gets a bounce. But when you get into these resistance levels, you don't want to see these big wicks like this right here. Comes right up and comes straight down. Like I said, until you're back above that 10-day simple moving average and consolidating above this level right here, the S&P is very vulnerable. And the volatility is going to get higher. So this is the half bar, and we got to get above here, but we have to get above this blue line. That's a 10-day simple moving average. And this trend line has to be support, not resistance. This is the upper area on a daily. When the S&P got up there, remember, our original target was 1475, and we sold into it. Okay, that's over with. Now we have a support level around 1410. That's going to be very crucial. And a new resistance level will be 1490. And then we'll talk about, as we go through the earnings, is if these earnings, like we know that a lot of them are going to go negative growth. So you got QE3, you got worldwide central bankers, and we'll cover more of that S&P later. But once again, the S&P has got some major resistance levels on that daily chart. And I'm going to conclude this S&P 500 at 14,444.9. 1,444.49. Okay, and it ended up on the day, but it has major resistance.